How to avoid European tariffs on luxury yachts. When the government introduces a new tax, most people groan and pay it. But for the ultra-wealthy, a new tax is often just a new puzzle to be solved. And with a proposed 15% U.S. tariff threatening European-made goods, the world of superyachts is buzzing with a brilliant and controversial solution. Let's set the scene. A potential 15% tariff, announced by the Trump administration, has sent shockwaves through the luxury marine industry. The reason is simple. Europe's shipyards are the global leaders in crafting the world's most magnificent recreational boats and yachts, while the United States is home to their biggest and most enthusiastic buyers. This creates a perfect storm, and industry experts are bracing for the financial fallout. The European boating industry didn't mince words, releasing a statement that underscored the gravity of the situation. The U.S. is the most important export market for the recreational boating industry in Europe. The 15% tariff rate presents serious challenges for businesses in Europe. Now, it's easy to think that someone who can afford a 10 million or even a 100 million yacht wouldn't flinch at an extra 15% tax. But that assumption misses a fundamental truth about wealth. As Kevin Merrigan, chairman of the yacht brokerage firm Northrop Johnson, puts it, "I don't know any stupid rich people. What matters to them matters. If they hear they're going to have to spend another 15%, it has an impact." The immediate question becomes, who foots this massive, unexpected bill? Most yacht construction contracts stipulate that the builder is responsible. This means buyers, many of whom commissioned their yachts years ago, as a custom build can take up to 3 years, are now locked in tense negotiations with shipyards to determine who will absorb the majority of the cost. But here's where the real ingenuity comes into play. Rather than just accepting the tax, brokers report that the wealthy will do what they have always done when faced with a new financial hurdle: find a clever, legal way around it. The most popular strategy is a practice known as foreign flagging. Here's how it works. An American buyer can choose to register their brand-new European-built yacht in a different country. Nations like the Cayman Islands, the Marshall Islands, Malta, and Jamaica are popular choices because they have favorable maritime agreements with the United States. By registering the vessel abroad, the owner can then sail it into U.S. waters und. Trump's new tariffs shake global markets. Weak jobs record sparks concern. The financial landscape has taken a turbulent turn. Markets have been shaken following President Trump's announcement of a sweeping new tariff strategy, combined with disappointing job growth figures. On the morning of August 1, U.S. stocks faced a downward plunge as the nation's labor market showed signs of stagnation, and the White House detailed a trade policy overhaul set to commence on August 7th, marking a significant departure from decades-long practices of free trade. This shift towards protectionism could fundamentally reshape international trade dynamics. In July, the U.S. economy saw only 73,000 new jobs created, falling short of expectations and indicating a halt in job growth. Even more concerning, the revisions for the previous 2 months revealed a downward adjustment of 258,000 jobs combined, as provided by new data from the Bureau of Labor Statistics. In this new tariff environment, a universal tariff rate of 10% will apply to countries with which the U.S. enjoys a trade surplus. This includes the majority of trade partners. Conversely, approximately 40 nations with existing trade deficits will have a minimum tariff rate set at 15%. Negotiations with key trade partners like China and Mexico are still ongoing, adding to the uncertainty. As part of this overhaul, President Trump announced a notable increase in tariffs on exchanges with Canada, rising to 35%. The White House clarified that products compliant with the United States-Mexico-Canada agreement would be exempt from these elevated rates, thereby lessening the potential financial impact on consumers. The July job report revealed disheartening figures. The addition of a mere 73,000 jobs was overshadowed by staggering revisions of the previous month's data, which saw May's projected job gains slashed from 144,000 down to a mere 19,000, and June's estimates adjusted from 147,000 to just 14,000. These changes prompted leading economist Diane Swank from KPMG to describe the situation as a clear stalling in the labor market. With such drastic cuts to job growth estimates, June's figures marked a significant low, the weakest growth seen since December 2020, specifying a concerning trend of underperformance in job creation for the year, which has been among the lowest in decades outside of recession periods. Joe Brusuelas, chief economist at RSM US, emphasized this report as a substantial setback for the economy since the end of the pandemic. The reaction from Wall Street was intense, with volatility making a comeback as traders unearthed the ramifications of Trump's new tariff initiative alongside a faltering job report. The CBOE Volatility Index, commonly referred to as the VIX, climbed by 22% to reach its highest level in over a month, indicating a significant rise in market anxiety. The Dow Jones Industrial Average saw a sharp decline, dropping by as much as 615 points, or 1.4%. The S&P 500 and Nasdaq similarly plummeted by 1.57% and 2%, respectively, with the broader indices on track for their largest single-day losses since earlier months. As traders processed the implications of Trump's tariff changes alongside the job report, Treasury yields dropped as investors flocked to the safety of bonds. Larry Tentarelli, chief technical strategist for Blue Chip Daily Trend Report, observed that with job growth falling short in July, the market reacted swiftly, resulting in falling yields and increasing speculation regarding potential rate cuts from the Federal Reserve. The U.S. dollar also edged lower, dropping by 1.1% against a basket of major currencies, while safe haven gold saw a rally of 1.5%. A new tariff regime is looming. Scheduled to take effect on August 7th, these tariffs will increase costs for goods imported from multiple foreign nations. While consumers might not immediately face these changes, since businesses often absorb some costs, these tariffs may accelerate the timeline for price increases in the marketplace, as companies might eventually pass down these incurred costs. Notably, the most punitive tariffs, hitting rates as steep as 41%, won't weigh heavily on major trading nations, but will impact countries like Syria and Myanmar, who face particularly high rates despite minimal trade relations with the U.S. Among the most affected products, electronics, including televisions, computers, and smartphones, could see increased prices, especially with significant tariff hikes from top suppliers such as India and Taiwan. Similarly, apparel and accessory prices are likely to rise, with most of these goods imported from countries like Vietnam and Bangladesh, each facing increased tariff rates from 10%. As the story unfolds, it's clear that Trump's latest trade strategy is reverberating throughout the markets, prompting investors to recalibrate their expectations regarding economic growth and earnings. Many experts are warning that the reality of these higher tariffs is beginning to settle into the markets, likening it to a sudden and unfortunate jolt. This shift raises questions about the long-term implications of Trump's trade policy as global financial markets attempt to adjust. As the landscape continues to evolve, the commitment to trade negotiations and their outcomes will be closely scrutinized, especially with critical deadlines approaching. Finally, the possibility of counter-deals or adjustments remains relevant, as trade tensions do not exist in a vacuum. The interaction between U.S. tariffs and response measures from impacted countries may lead to further market fluctuations and economic consequences. The question remains for readers: how do you view the impact of these tariffs on the global economy? Are they a necessary measure for protectionism, or simply a recipe for broader economic strife? Your thoughts are welcomed. New tariffs. The rising cost of Ozempic Wegovy. Imagine a scenario where your favorite medications could suddenly become much more expensive due to new trade policies. That's exactly what's at stake with the upcoming tariffs between the U.S. and the European Union. But here's where it gets controversial. These tariffs could potentially hike the prices of popular drugs like Ozempic and Wegovy by by a significant margin. The trade deal is set to impose a 15% tax on nearly all goods coming from Europe, ranging from luxurious French wines to cutting-edge German cars and even essential pharmaceuticals. Among the brands that could be affected are Ozempic and Wegovy, two injectable medications that have gained popularity for their effectiveness in treating diabetes and aiding weight loss. Both drugs are manufactured by Novo Nordisk, a company based in Denmark. Wegovy, the FDA-approved version of the drug used to treat obesity, has seen a surge in demand, with approximately 200,000 weekly prescriptions in the U.S., according to Novo Nordisk. Even before the tariffs, these medications were already considered prohibitively expensive for many individuals. Without insurance, patients could expect to pay around $500 per month for these drugs. For those fortunate enough to have health insurance, the costs are generally lower. Novo Nordisk reports that 85% of their U.S. patients with coverage pay $25 or less per month. However, once the tariffs are implemented, the cost of importing these medications into the U.S. will increase. The question remains, who will ultimately bear this additional expense? Rina Conti, an associate professor at Boston University's Questrom School of Business, explained to NBC News that pharmaceutical companies might simply raise their prices to cover the higher import costs. This could mean that individuals without insurance would see a direct increase in the cost of their medications, while those with insurance might end up paying more in the form of higher premiums. Joe Brusuelas, principal and chief economist for RSM US, summed it up succinctly in an interview with Axios. The big picture is the cost of imported drugs is about to become more expensive for all Americans. Other well-known drugs like Botox, Viagra, and Keytruda, a cancer medication, are also manufactured in Europe and will be subject to these tariffs. Initially, it was thought that some generic drugs would be exempt from the tariffs, but as of the latest updates, the specifics were still uncertain. When asked about the potential impact of the new 15% tariff on Ozempic and Wegovy, a Novo Nordisk spokesperson stated that the company remains committed to improving patient access and affordability. They emphasized their ongoing efforts to find solutions that ensure people can continue to access the medications they need. This situation raises important questions about the balance between trade policies and the accessibility of essential medications. How should pharmaceutical companies respond to increased import costs? And what measures can be taken to protect patients from price hikes? These are issues worth discussing and debating. What do you think? Should the government intervene to protect patients from these potential price increases, or should pharmaceutical companies be allowed to adjust their pricing as they see fit?